Good day, Team Telco. Thank you for joining us once again into this session called Understanding Productivity, Part 3. This is the continuation of a series that we've been looking at where we're trying to understand productivity, the measurement of it. And in Part 3, what we're going to look at is the importance of time accounting. The importance of time accounting. So maybe if we take a step back and we understand how time in an organization comes to be. Time in an organization results from a process of acquisition of a resource, a human resource. And this acquisition of a human resource comes about when there's an employee contract that is put into place. That employee contract, basically, if you boil it down to its basic parts, is the process by which an organization acquires the time and the skills of a particular person or human resource. So let's say that you are a managing director and you've been given a mandate by a board of directors to and you've been given a mandate by the board of directors to set up a company. You start off as one person. Immediately, what you're going to do is you realize that in order to run a business that services multiple clients and does multiple activities, you need a team that is bigger than yourself. So perhaps you'll go out into the job market and you'll acquire three other managers. Three people with diverse skills. Maybe one person might be a finance manager, another person might be an operations manager, and another person might be an administration manager. So you go out and you acquire skills through employee contracting, where you're going to get diverse skills and diverse time. You're going to multiply time by acquiring more people because you only have very limited time. Those people, depending on the size of the organization, may themselves need to build teams around them that will allow them to carry out their duties and their mandate. So each of these managers will acquire time and skill through employee contracts by acquiring and onboarding human resources into their teams and into their departments. I'm sure, as you can see through this diagram, this is how you multiply the time, the skill, and you make sure that you can be productive as an organization or as a managing director. You make sure you can attend to your clients and so on by multiplying the number of people that have different kinds of skills and different kinds of capabilities by adding those onto your team. So essentially, time is a resource, just like any other resource in a business. And in our particular business, the EXCO is accountable for the productive utilization of the time, talent, and skills of all the employees in the organization. So let's say that Telco has 100 employees. Each of those employees is contracted, has an employee contract that mandates them and allows them by labor law to work up to 191 hours. That means EXCO is accountable for the productive utilization of 19,100 hours in the organization. And it measures KPI that measures that productivity is something called revenue per employee, which we shall look at in another session. Management, each of the managers that fall under EXCO is accountable for the productive utilization of time, talent, and skills of all the employees in their department. So let's say the average department has got 10 employees, and each of those employees has got hours of up to 191 hours by labor law. That means each manager is responsible and accountable for 1,910 hours in their department. And productivity in their department is measured by the key performance metrics of that team or that department. Lower than managers or maybe team leaders. Team leaders are accountable for the productive utilization of the time, talent, and skills of all the team members in their team. So let's say that each team leader is responsible for 3 or 4 or 5 people. Each of those, the team leader is accountable for 3 times 191 hours of the people that are in their team. And finally, each individual employee including managers, including team leaders, and including Exco itself, each individual employee is responsible for the productive utilization of his own time, his own talent, and his own skill, which as according to labor law is something around 191 hours, and managers usually have slightly more than that they're responsible for due to the nature of their responsibilities. So essentially, all that this says is that every single employee is accountable to the business for the correct and productive utilization of their time and their time and their productive use of that time to the organization. So, what is time accounting? Now that we've looked at how it comes up, how time as a resource comes about in an organization. Well, perhaps the easiest thing to do is to, first of all, for us to look at a resource that we're far more familiar with when it comes to accounting terms. Accounting basically is the process of recording transactions pertaining to a business, and that's usually financial transactions. And the resource that comes to our minds more easily is we're used to accounting for money, and money is a resource in a business. So, for example, if you went to the cash department and you requested a petty cash of USD $500, the disburser would have to account for how much they've given you and why, and the recipient would have to account for what was used, how much was used, what was it used for, and give proof of utilization for business purposes. Proof would be invoices, receipts, and such other things. And the process of recording that disbursement and what it was used for is called, and usually in the systems of a business, we record transactions. So there are many kinds of business resources that have to be accounted for. There's cash, there are inventories, there's fuel, there's time, and many, many other resources that businesses have that need to be accounted for. And so in a business, any resource at the end of the day boils down to money and ends up being tracked and accounted for in monetary terms. But in order to get to accounting for it in monetary terms, you first need to understand what are the movements of that particular resource. And so time transactions, in our case, are recorded through things like timesheets, activities, scheduled activities, tasks that have been completed, tickets, and so on. So each company employee is responsible and accountable to the business to record his or her time transactions. Each manager or supervisor of that employee is accountable for the time and the utilization of both his own and his team's time transactions. They're responsible to verify them, and they're responsible to monitor them and validate them. So, accounting in the sense of time is all about tracking, monitoring, evaluating, and giving feedback on the utilization of the time as a resource that the organization has acquired and is paying for. So, in order to do this, a manager has to do four main key things. They need to define the key activities of the resources that are under their care, including the time resources for their employees. They need to create tasks or projects around these. They need to track the timesheets against the tasks, and then they need to monitor, evaluate, and validate these time transactions on a daily, weekly, or monthly basis. I know that this has been a very short training and it may or may not have made sense to you, but if you have any questions, if you want any clarity about the process of time tracking and the process of monitoring and evaluating and giving feedback on time transactions within your department or within the organization, please don't hesitate to reach out to me or to any of your Exco members who I'm sure will be very capable about giving you guidance in this regard. Have a good day.